You could be missing out on hundreds of dollars towards your rates bill without even realizing it. And for many SuperGold card holders, that number just went up to $830. If you own your own home and you're on a fixed income, this update could genuinely change how much you pay this year, and there's a deadline attached that you need to know about right now. I'm David, and you're watching New Zealand Pension Plan, the channel where we break down NZ Super, government support programs, and important updates that could affect your finances, so you can make informed decisions and make sure you're receiving every entitlement you may qualify for. Now, before I go any further, I want to clear something up because there's a lot of confusion floating around online about this exact update. What we're talking about today is not a change to your NZ super payment. It's not a new WINZ benefit, and it isn't something MSD pays out. This is the Rates Rebate Scheme, and it's run by the Department of Internal Affairs together with your local council. SuperGold cardholders get special treatment within that scheme, which is why you'll see it described as a SuperGold card update. But I want you to understand exactly what you're dealing with, because getting this right could be the difference between an easy application and a frustrating one. So let's start with the big number. From the 1st of July 2026, the maximum rates rebate is rising from $805 to $830. That's confirmed. It comes straight from an official announcement by the local government minister and the seniors minister, and it's not a rumor or a guess. If you're a homeowner with a rates bill and you qualify under the income rules, this is real money coming off what you owe your council. Stay with me, because in just a moment, I'm going to explain exactly who qualifies for the full amount, who gets a smaller rebate, and the one income detail that trips up more pensioners than almost anything else in this scheme. Let's talk about who this is for. The Rates Rebate Scheme exists to help low to middle income homeowners with their council rates. It's been running for years, but in the last couple of budgets, the government has made specific changes to help SuperGold card holders in particular. If you're over 65 or your partner is and you hold a SuperGold card, you now sit on a more generous income threshold than the general public. That's an important distinction, so let me give you the actual figures. For SuperGold card holders from the 1st of July 2026, your household income can be up to $46,400, and you can still receive the maximum rebate. That's up from $45,000 the year before. To put that in perspective, a couple who are both receiving NZ superannuation and nothing else will usually sit right around this income level, which means many superannuitant couples should qualify for the full $830, provided their rates are high enough. And that's the next piece of the puzzle. To get the maximum rebate as a SuperGold card holder, your rates also need to be over $2,000 a year. If your rates are lower than that, your rebate will be calculated on a formula, and it may come in under the maximum. So, two things need to line up. Your income needs to be within the threshold, and your rates need to be high enough to trigger the full amount. If you're not a SuperGold card holder, the general threshold is different. For other households, the income limit for the maximum rebate is rising to $33,210 from the 1st of July. If your household income is above that, you might still get a partial rebate. It just won't be the full amount. Now, here's something I want you to really pay attention to because it's one of the most common mistakes people make with this scheme. When we talk about income here, we're not talking about your NZ super payment alone. We're talking about your total household income before tax for the tax year running from the 1st of April 2024 to the 31st of March 2025. That includes NZ superannuation, any veterans pension, overseas pensions, WINZ payments, ACC compensation, wages if you're still working part-time, rental income, interest, dividends, and PIE income. It also includes your partner's income if they live with you and are a joint homeowner. This catches people out more than anything else. I've heard from viewers who assumed their rebate would automatically max out because they're only getting NZ Super, but then they forgot to account for a term deposit that's earning interest, or a small rental property, and that pushed their household income just over the threshold. It doesn't disqualify you completely, but it can reduce what you receive. So before you apply, it's worth actually sitting down and adding up every source of income for you and your partner over that specific 12-month period. In a moment, I'll walk you through exactly what happens if your income is a bit higher than the threshold, because it's not as simple as being cut off completely. But first, I want to address the elephant in the room, because a lot of headlines and social media posts are framing this as rebates opening today, right now, everywhere in the country. That's not quite accurate, and I want to be straight with you about it. The new $830 maximum and the new income thresholds officially take effect from the 1st of July 2026. New application forms become available from councils and through the government website from that date as well. But here's the catch. Not every council opens applications for the new rating year on exactly the same day. Some councils process the tail end of the previous year's applications first and only open the new intake a little later, sometimes not until August. So if you jump online today expecting your specific council to be accepting new applications, you might find they're not quite ready yet. My advice here is simple. Don't rely on a video, a Facebook post, or even a headline to tell you the exact day your council opens applications. Go directly to your local council's website or give them a call and confirm exactly when they're accepting rates rebate applications for the current rating year. That one phone call could save you a wasted trip or a frustrating wait. Now let's talk about deadlines, because this is genuinely important, and it's where people lose out on money they were entitled to. The closing date for the current 2025 to 2026 rating year rebate is the 30th of June 2026. If you missed that, don't worry, because a new application window opens for the 2026 to 2027 year, with its own closing date that you'll want to confirm with your council. But here's the part that really matters. There is no backdating. If you miss the deadline for a rating year, that money is gone. You can't apply late and still receive it. So if you've been putting this off, thinking you'll get around to it eventually, this is your sign to actually put it on your calendar. Keep watching, because next I want to explain exactly what documents you'll need, because turning up unprepared is another common reason applications get delayed or rejected. To apply for a rates rebate, you'll need your current rates notice from your council, showing what you're being charged for the current rating year. You'll need proof of income for the tax year running from April 2024 to March 2025, for both yourself and your partner if applicable. This usually comes from an IRD summary of income, which you can get through My IR, or a letter from Work and Income if you receive a benefit. If you're self-employed, you'll need a statement showing how your net profit was calculated, and I want to flag something important here. If you run a business at a loss, that loss cannot be used to offset other income for this calculation. That's a specific rule within the scheme, so don't assume a bad year in business will automatically boost your rebate. If you hold a SuperGold card, you'll need to include a photocopy of the signed side of your card with your application. Some councils, like Auckland Council, will even let you take your card into a local library for verification if you're not comfortable photocopying it yourself. If you're living in a retirement village under a license to occupy arrangement, you'll also need a separate certificate completed by your retirement village operator, which you can usually get from them directly or through the government website. Once you've got everything together, you apply through your local council, not through Work and Income, and not through Inland Revenue directly. Each council has its own process. Some let you download the form online, others will post it out, and some will have physical copies available at council offices. Processing can take up to 2 months, particularly if you apply during the busier periods between August and November, or between April and June. So applying early in your council's window is genuinely worth doing, rather than leaving it to the last minute. There's one more detail I want you to keep in mind, because it surprises people. This rebate isn't a check that lands in your bank account separate from everything else. It's applied directly to your rates account with the council. So practically speaking, what you'll see is a reduction in what you owe spread across your rates installments for the year, rather than a lump sum payment showing up unexpectedly. Now, let's talk about why this change matters in real terms, because I always want to bring this back to your actual situation, rather than just reciting numbers at you. Say you're a SuperGold card holder. You own your home outright. Your only income is NZ superannuation as a couple, and your rates this year come to $2,200. Under the old rules, you may have been eligible for up to $805 off that bill. Under the new rules from the 1st of July, that maximum rises to $830, an extra $25 in your pocket, assuming your income still sits comfortably within the new $46,400 threshold. It might not sound like a huge jump on its own, but combined with the higher income threshold, it means more people qualify for the full amount than before, and fewer retirees get pushed into a reduced rebate simply because their income crept up slightly to keep pace with the cost of living. That's actually one of the stated reasons behind these changes. The government has been explicit that raising the income thresholds is meant to stop pensioners losing eligibility just because their income rises slightly with inflation. If you were right on the edge of qualifying last year, it's worth checking your position again under the new thresholds, because you may now qualify for more than you did previously. There's also a broader point worth making here, because I know a lot of you watching are juggling more than one form of government support at the same time, and it's easy to lose track of what's connected to what. The Rates Rebate Scheme sits completely separately from your winter energy payment, your accommodation supplement, and your community services card. Qualifying for one doesn't automatically mean you qualify for another, and missing out on one doesn't affect your eligibility for the rest. If you're on a fixed income and you're not sure whether you're getting everything you're entitled to, it's worth treating each of these as its own separate check. I genuinely encourage you to use the government's own rates rebate calculator on the govt.nz website before you apply, because it will give you a personalized estimate based on your actual income and rates, rather than relying on the general figures I've given you today, which apply to most people but not every single situation. I also want to spend a moment on retirement villages, because I get questions about this regularly. If you live in a retirement village under a license to occupy agreement, rather than owning your home outright, you can still apply for a rates rebate in most cases. The process is slightly different because your retirement village operator effectively pays the rates on the property, so you'll need a specific certificate completed by your village operator confirming your situation alongside your own application. If this applies to you, the best first step is simply asking your village operator directly, since they'll usually have handled this before for other residents and can point you toward the right paperwork. Another situation that comes up often is company share apartments, sometimes called owner-occupier flats. If you own a company share apartment and live in it yourself, you may still be eligible, but the ownership structure means you'll likely need additional documentation to prove you're the occupier as well as the shareholder. Again, your counsel will be able to tell you exactly what's required in your specific case, and it's worth asking early rather than assembling paperwork after you've already started your application. And if your home is owned through a family trust, don't assume that rules you out either. If you're a named trustee and you're listed correctly on your counsel's rating information database, you can still apply. The key is making sure the counsel's records actually reflect your situation, so it's worth checking your listing on the rating information database, sometimes called the RID, before you submit anything. Keep watching, because there's still one important area I haven't covered yet, and it's the one that determines whether you get the full rebate or a reduced one if your income sits just above the threshold. Let's go back to income, because I promised I'd explain what happens if you're slightly over the limit. If your household income is above the threshold for your category, whether that's the $46,400 SuperGold threshold or the $33,210 general threshold, you don't lose your rebate altogether. Instead, it reduces gradually the further above the threshold your income sits. This is often described as an abatement, similar in concept to how some other forms of assistance taper off rather than cutting out completely. In practical terms, that means it's always worth applying even if you're not certain you'll qualify for the maximum, because a partial rebate is still real money off your rates bill. And the only way to find out your exact entitlement is to actually go through the calculation with your counsel or the online calculator. One more practical tip before we move on. If your income changed significantly during the assessment period, for example, if you retired partway through the year and moved from wages onto WINZ superannuation, make sure your documentation reflects that accurately. Counsels are working from the gross income figures for the full 12-month period from April 2024 to March 2025. So a partial year of wages combined with a partial year of NZ Super still needs to be added together and reported correctly. Getting this wrong, even accidentally, can lead to processing delays while the counsel asks for clarification. So it pays to double-check your IRD summary matches what you're declaring. In a moment, I'll cover the biggest myths circulating about this update, because separating fact from fiction is exactly what this channel is here for. Let's go through what's actually confirmed versus what's being misrepresented online. The first myth is that this is a new SuperGold Card benefit, or some kind of pension top-up. It isn't. Your fortnightly NZ super payment is not changing because of this announcement. This is entirely separate. It's about your council rates, and it only helps you if you're a homeowner who pays rates. If you rent your home, this particular scheme won't apply to you directly, though it's always worth checking with work and income about other support you might be entitled to, like the accommodation supplement. The second myth is that the maximum rebate figure itself is somehow uncertain or exaggerated. It isn't. $830 is the confirmed maximum from the 1st of July 2026, straight from the official government announcement. That part of the story checks out completely. The third myth, and this is the one I really want you to walk away remembering, is the idea that applications are open everywhere today, on one single national date. That's only partially true. The scheme's new thresholds and forms are effective from the 1st of July, but your specific council decides when it starts processing new applications, and that can vary by several weeks. Always confirm with your own council before you get your hopes up about a specific date. And the fourth myth is that every SuperGold card holder automatically gets the full $830 just for holding the card. That's not accurate either. You need your rates to be above $2,000 a year, and your household income needs to sit within the threshold. Most superannuitant couples earning only NZ Super will likely meet both conditions, but it's not a blanket entitlement just because you're over 65. So here's what I want you to actually do after watching this. First, work out your total household income for the tax year ending March 2025, including your partner's income if applicable, and compare it against the $46,400 SuperGold threshold, or the $33,210 general threshold. Second, check your current rates notice and see whether you're above or below that $2,000 rates threshold. Third, contact your local council directly to confirm exactly when they're accepting applications for the current rating year, rather than assuming it's today just because you saw a headline. And fourth, get your documents ready in advance, your rates notice, your IRD income summary, and a photocopy of your SuperGold card if you hold one, so that when your council does open applications, you're ready to submit straight away rather than scrambling at the last minute. This is exactly the kind of update where a bit of preparation now can genuinely put money back in your pocket later in the year. Take a moment to consider whether this applies to your situation, especially if you're a homeowner on NZ Super and you haven't applied for a rates rebate before. A lot of eligible pensioners simply don't know this scheme exists, and every year money that could have gone towards easing their rates bill goes unclaimed. Make sure you're not missing out on support you may be entitled to. To bring it all together, from the 1st of July 2026, the maximum rates rebate rises to $830. SuperGold cardholders benefit from a higher income threshold of $46,400, provided their rates are above $2,000 a year. This is administered by the Department of Internal Affairs and your local council, not by Work and Income or MSD, so applications go through your council directly. The current rating year's deadline is the 30th of June, with no backdating if you miss it, and your specific council will confirm exactly when the new rating year's applications open, which may not be the same day the new thresholds take effect nationally. Getting your income figures and paperwork sorted now puts you in the best position to apply as soon as your council's window opens. If you found this update helpful, make sure you subscribe to New Zealand Pension Plan. I'm David, and my goal is to help you stay informed about NZ Super, WINZ, MSD, and every important government support update that could affect your finances. Thank you for watching, take care, and I'll see you in the next update.